Okay, now let's look at this problem. That's the example one on the slide. So here, uh, that is the asset is financed with debt and equity, and that coupon is $3 million per year. Principal is 100, and the debt mature in 10 years. And the market value of debt is 100 million. For equity, the dividend is expected to be 3 million every year, and equity value is $60 million. With this data, we can calculate the cost of equity, cost of debt, and the WACC. Cost of equity is dividend divided by market value. Here, the growth rate is 0. So the dividend yield is the cost of capital. Same thing is for cost of debt. It is coupon divided by debt value. And we know the market value of debt and equity, so we can calculate the WACC. Market value of debt is 100, market value of equity is 60. So we can calculate, and then we can calculate the WACC. It turned out to be 3.75%. So you see it's between 3% and 5% between the cost of debt and the cost of equity, because the debt has higher weight, so it's closer to 3%. Now we calculated the value of debt cash flows and equity cash flows discounted by WACC. First, let's look at the value from debt cash flows. So there are two parts. The first part is the coupon part. Coupon is B1, right? 3 million, and discounted by this WACC. It lasts for 10 years. And then the second part is the principal part. Principal is B2 is 100 million, and discounted by 10 years. So that's principal part. Add together, we get this 93 million. And the value for equity is the dividend divided by the WACC. We get 80 million. Together is 173 billion. When we discounted cash flow with WACC. But the sum of asset values, this as the equity and debt is 100 plus 160 is 160 million. So you see, these two values different, right? The two values different. So what can we do? The way to resolve it is to instead of saying this is debt maturing 10 years, we keep rolling over the debt to infinity, okay? Now let's redo the calculations. Everything is same except the debt is perpetual. So again, coupon 3 million, principal 100 million, and debt value 100, equity is same, okay? So we get same cost of equity, same cost of debt, and same WACC. But here, debt value calculated from this WACC is different. It's simply the coupon discounted by WACC, okay? Because it's roll over to infinity. And the result is 80 million. Equity part is same. So 80 plus 80 is 160. 160. 160. So this is same as the sum of equity and debt. So you see in this case, two different methods calculate the asset value. We get same answer, provided we assume that does not mature. Maturity of that is perpetuating. Okay. Here we have an exercise, essentially the same, but change a little bit numbers, and we can do the calculation, and we can try that. Now let's go to example 2. In example 2, we assume that dividend and equity dividend change at the same rate. Specifically, we assume that the coupon rate increased 2% per year, and the dividend rate increased by 2% per year, and see what happens. So first, we calculate the cost of equity. Cost of equity is the dividend yield plus growth rate of dividend. Okay. And here we get 8%. Cost of debt, same thing. It's the coupon yield plus growth rate of coupon. Here we get 5%. And then we can calculate WACC, turn out to be 6%. And we can calculate the value of debt cash flows discounted with WACC. And we can calculate value of equity cash flow discounted by WACC. And they add up to 150. Value of debt is 100. Equity value is 50. So they add up to 150. So these two answers are the same. This means when the rate of change of this coupon rate and dividend rate are same, discounting by WACC gives us correct answer. Okay. So that's the example 2 from the slides. Now let's look at third example. In this example, we assume that the coupon rate, is constant. That's normal, right? Most debt, they are constant. But the dividend will change by, say, 4%. Dividend change by 4%. And say this is a growth stock, right? Dividend will increase. And here, debt value 100, equity value 100. And we can do the cost of capital, right? Our cost of equity. Cost of equity is the dividend yield plus growth rate, 7%. Cost of debt is the yield of debt. And we can calculate this WACC. And now we can calculate this value of debt cash flows discounted with WACC. So this is the this is okay, coupon, right? Coupon rate, yeah, discounted by this is WACC. Okay, we minus B2 0%. We can put there. We can ignore it. It's same, right? It's rate is 0, so it's we get 70, and this equity value discounted by WACC. This here we get this B4 is dividend, equity dividend. WACC minus B5. B5 is the growth rate. We get dividend growth rate, 4%. So we get 300. So there are some 360. this is much higher than the asset value of sum of equity and debt. They add up 200. So you see that with growth companies, discounting by WACC overestimated the value of the asset, right? Because discounting with WACC we get 360, but actually the market value is only 200. Now let's go to the last example. In this case, we assume it is a declining company. The dividend increase rate is negative 2%. This means the company is declining. And we see in this situation what this calculation of WACC will bring us. We do the same thing, right? Cost of equity, cost of debt, or WACC, and value from equity cash flow, debt cash flows, and value from debt cash flows, or value from equity cash flows. That get to 141. This less than asset value as the sum of equity and debt. They add up to 150. This means that for a declining company, using WACC to calculate asset value will undervalue the asset.